Hello and good evening, everyone, and thank you for tuning in to Investigation of Bitcoin as the new digital gold. My name is Eamon Gebre, Head of Wealth Advisory at Starwood. Thank you for tuning in. I am accompanied by my wonderful colleague, Professor Jiro Kondo. Thank you very much for joining us today. How are things in Montreal?
Things are great. It's a beautiful late morning, so can't complain. A little bit cold if you go outside, but yeah, no, things are wonderful here. Thank you, and it's a real pleasure to be here and to interact with our community.
Oh, that's spectacular. And thank you for those who've made the time to attend. I know most of you are probably on your way back from work. If you're listening in your cars, please do drive safely. For those of you who are still in the office, hopefully you've got your headphones on so you won't be interrupted. We're going to be taking on a journey today, and we're going to be, diving into the reasons why, Sarwa has decided to offer Bitcoin exposure to the portfolios. Now, I just want to give it a minute or two for others who kind of just to jump in into the session. But in the moment, I'll kind of give you a little bit of a highlight as far as the ground rules. So we're going to be presenting today, and we are going to open it up for a Q&A at the end of the session. Feel free at any point in time. There is a question or button on your Zoom link so that you can actually type in the questions, and we'll be addressing them together at the end of the session itself. I think maybe that's a good enough time. It's been a couple of minutes in. Shall we start?
Sure.
Absolutely. All right. So if we go to the next slide here, I wanted to actually have a proper introduction first to Professor Jiro Kondo. He is head of portfolio construction for us here at Sarwa. He's also an assistant professor at McGill University in the Desautels. I was trying to practice this actually several times. It didn't work out for me. You can tell I dropped French rather quickly in school, but the Desautels Faculty of Management. He's an expert in financial advisor and broker misbehavior, and has specially undertaken research on the topic of self-regulation in the US retail securities brokerage industry. Now, he's received his training in financial economies at Princeton University and MIT. He's received his PhD from there. Professor Kondo is a teacher, and Professor Kondo's teachers also include academic leaders in the practice of investment management like Burton Malkiel and Stephen Ross. Prior to joining McGill, Professor Jiro was on the faculty of the Northwestern University's Kellogg School of Management, where he received numerous teaching awards. And even today at McGill University, he was recently honored as being Professor of the Year for his mentorship that he provides to many students and to the wider community in Montreal. So thank you again, Professor Kondo, for joining us today.
It's a pleasure.
Excellent. Now, I want to move on to the next slide and to kind of jump into what we're going to be talking about today. Now, it's important to highlight that we don't have a crystal ball. We can't predict the future. And when it comes to our views that are, that we're taking today, should not be interpreted as one-on-one financial advice. Every individual has their unique circumstances, and it is advisable to speak to an advisor to share with them what your goals and your hopes and your dreams, so that they can actually cater, a solution for you to help you reach your financial goals. Two individuals might have the same financial goals, but they may have a different, strategy in mind to be able to achieve them, or a risk tolerance. So it's important to have a one-on-one discussion before, proceeding with any financial advice. Now, let's talk about Bitcoin. Okay, so we're going to talk about the introduction of Bitcoin. We're going to talk about Bitcoin being potentially digital gold, Bitcoin as a diversification tool, and why Sarwa has introduced crypto to portfolios. And of course, as I said, we'll open it up for Q&A at the end of the session. I'm feeling parched already, so it's a good time for me to have some water. But let's talk about introduction to Bitcoin. Now, when we go to the next slide, often when we refer to Bitcoin, the name Satoshi Nakamoto comes up often, as he is cited as being the father of Bitcoin. But interestingly, the actual person that the name represents has never been found, but which has led many people now to believe that it's actually a pseudonym or an alias for a person or potentially a group of people that started Bitcoin. Till date, there has been no clarity, and all leads have gone cold. Now, I know for those in the audience who are looking at the image right now and doing a split screen look at Professor Jiro Kondo and wondering if, is Satoshi joining us today? I've had coffee with this gentleman just this last summer. He is not Satoshi at all. Well, with those glasses, maybe potentially, actually, I don't know.
Yeah, when I think of Satoshi, I really think of him as a concept and a more general concept than just Bitcoin. Really, it's a concept of community and value creation, and working so hard that you don't have time to cut your hair or figure out how to find stylish sunglasses, so you pick something weird looking. And in our own little way, I feel like at Sarwa, we're trying to do something a little bit similar around community and value creation. So, maybe in that sense, it's not an accident that there's a similarity and resemblance.
No, absolutely. I mean, it's been a cult following on Satoshi Nakamoto and what he's developed. And it's interesting, but because what we know so far is that Satoshi has published a white paper in 2008 that jump-started the entire development of cryptocurrency as we see it today. This white paper or manifesto of sorts was titled Bitcoin, a peer-to-peer electronic cash system. Now, this paper highlighted that a digital currency that operated in a supply capped monetary system that was fully decentralized and incorruptible. And this currency would actually allow secure peer-to-peer transactions without the involvement of any middleman, whether that be a government, a financial system, or a company. And that these transactions would actually be tracked through a blockchain, a ledger like those used by financial institutions, except that this ledger would be publicly distributed across an entire network and fully visible. This ledger would be fully secured or encrypted by cryptographic means to protect users from fraud. Now, this network essentially eliminates the current model of how we transact with money. The current system that we have in place is a trust-based model where you rely on third parties to create a digital representation of hard cash. I'll give you an example. You log into your online banking, you see your balance in your bank account. Now, that balance isn't sitting, the hard cash isn't sitting in the bank, nor is it sitting in your home or anywhere for that matter. Now, whether you're shopping for clothes online or using credit cards in stores, the payment standard has always been through financial intermediaries or financial institutions that approve and execute each transaction. But what Bitcoin has done is by creating an electronic peer-to-peer cash system, it eliminates the need for trust in third-party providers. Bitcoin is independent. No one person owns or controls Bitcoin, and anyone can participate in it. Now, it's kind of important to kind of give context as to why individuals would even be interested in decentralizing money. It seems a little bit far-fetched and kind of, apocalyptic in a sense, right? But for that, I need to kind of give you context by going back a few years to the, 2008 financial crisis in the US. This period of time caused a lot of devastation around the world. Individuals lost their homes, their jobs, their savings, and much of the blame was actually squarely placed on financial institutions for acting and behaving not in the interest of their clients or the public at large. And the impact of those actions actually accounted for a loss of roughly $10 trillion worth of wealth. And the follow-on lack of accountability and government bailouts, printing of money, subsequent bonuses that bank executives received left a sour taste in many people's mouths and eroded the trust in the financial sector. Bitcoin, on the other hand, isn't impacted by external bodies as it is not issued by a central bank or backed by any government. This white paper, coincidentally released in the middle of this economic crisis, seemed to have hit a nerve and got some people's attention. Now, I want to talk about the supply versus demand factor when it comes to Bitcoin. And I think this is really important because now, while having control of, say to speak, of your own money is attractive to some, the economics behind the value of Bitcoin is what actually has intrigued even more people. Bitcoin is very similar to most goods and services in that it's based on supply and demand functions. This currency has a maximum supply of 21 million Bitcoin. Can't simply be created arbitrarily. It's actually set forth in its code that it must have a limited and finite supply. And for this reason, there will only ever be 21 million Bitcoins ever produced. And Bitcoin has to be mined via computational means. And I apologize if this gets a little bit technical, but it serves to help you understand why the importance of this supply limitation is that it must be mined via computational means. And it relies on a complicated math problems, cryptographic math problems that miners all compete to solve. And the first one to do so is rewarded with a block of newly minted coins. And so far, we have about 18,780,000 Bitcoins that have been unlocked. And the majority of which was actually mined in the first 10 years since the initial launch of the Bitcoin network. Now we've got about 2.2 million, give or take, coins to go. And it may feel that, when you look at the chart, that we're in the final stages of Bitcoin mining. Now, while that might be true, it's true in a very limited sense, because though the large majority of Bitcoins have already been mined, the timeline as far as when it's going to be mined completely is much more complicated. Because the process in which miners, mine, Bitcoin, it adapts. It adapts over time. So when Bitcoin was first launched, the reward given to miners was 50 Bitcoins. In 2012, it was halved to 25 Bitcoins. In 2016, it halved again to 12.5 Bitcoins. And as of February of this year, miners now gain 6.25 Bitcoins for every new block mined. And it's estimated at this rate that for all the Bitcoins in the world to be mined, it'll be by year 2140. So much, further on down the line from us. Now, Bitcoin today is considered a top cryptocurrency in the world by market value. As of this morning, just did a quick check, it's reached over $51,000 per coin, which is significantly, higher than when it first started off. And this is where I think many of us are going to be kicking ourselves in the butt. But it was at 8 cents at one point in time. So huge disparity when it comes to the value of it. Now, it's gone down this road, right? And we look at the current state of Bitcoin and the current narrative that we talk about. If we can go to the next slide, Professor Kondo.
Maybe if I can chime in just for one second before we go to the next slide. If you look at the chart on the right, I just want you to realize that the end of the chart is on May 21st, 2021. Starwood launched our crypto offering in the middle of July, roughly. So we kind of actually bought near the bottom of the dip, and it's been fortuitous timing because it's actually performed fairly well since we launched. Just thought I'd note that just in case people are wondering whether their position has has fallen in value. In our case, since we've launched, that's not been the case. I just wanted to highlight that.
Absolutely, and it does reflect on the number of the portfolios that we've seen with those early adopters who have purchased Bitcoin through our portal, our platform. And as I was saying, that the narrative has changed quite a bit over the years, right? The perception by a lot of the incumbents when it first started, and when I say incumbents, I'm talking about banks, financial services firms, intermediaries, government entities, was that this is a cute pet project, that it had no hope of having any real life utility or being a serious contender in the global financial system. So for the most part, it was kind of ignored to their peril, as we see today. At one point in time, it was actually vilified as being the choice currency for criminals, in the underworld for illicit activities. But today, we have financial, services behemoths, like BlackRock, JP Morgan, Bank of New York Mellon. Now they're starting to offer cryptocurrencies and related services to their customers and adding further legitimacy to an asset that, for example, Charlie Munger from Berkshire Hathaway once characterized as contrary to the interests of civilization. All things said, Bitcoin has proven to be a catalyst for revolutionary change and a new way of thinking about money, and doesn't seem to be slowing down. And some would perceive this asset as potentially being the new digital gold, hint, 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 pun intended. So on that note, Professor Kondo, I wanted to, pose to you, is Bitcoin the new digital gold?
Thank you very much. I think before answering that question, it's useful to first understand why gold is a particularly interesting asset. It's tough to say I am X until I know what is X. So when we say gold in this context, and when we really hint towards this being something very special, it's important to give that background context, and in particular that background context and how it fits into Sarwa's kind of real governing principles when it comes to making investments on the behalf of our clients, where we've generally always prioritized this notion of optimally diversifying our clients' risky holdings in a low-cost way. And so I'll tell you guys a little bit first about the gold and specifically the diversification benefits that gold has traditionally provided. First thing I want to do is just give you guys a high-level intuition on how we measure, roughly, I'm oversimplifying, but this is, let's call it a good 80-20 on the principle, how we measure the diversification benefit of an asset. Right, a diversification benefit is the ability of an asset to lower the risk of your portfolio. And a diversification benefit, in some sense, can be thought of as being proportional to the product of two things: asset correlation with the market and asset volatility. And you'll notice we put asset correlation with the market in teal here. If we think about gold in the context of this diversification benefit, there's something that's been historically very unique about gold. So that's what I mean by a rare statistical quality of gold. When I say rare here, I'm not in and of itself saying that it's about the rarity of gold per se. And when I say quality, I don't mean that it's a nice, bright, shiny object. I mean it from a finance standpoint, thinking about the statistics and financial economics of investing. And the thing that's really unique about gold there is that it has historically had a very low correlation with the market. And in fact, on average, over the course of history, that correlation has been negative. There are very few assets that have that property. In fact, if someone comes to me and says, I own a stock that has negative beta, which is a bit of a similar concept, the first thing that I say to myself is this must be a company that has long exposure to gold. Maybe it's a gold mining company. I mean, that's how rare this type of asset is. And that property allows the asset, so gold, to act as very effective insurance in your portfolio. And right, so you can think of like insurance as being, a supercharged way to achieve diversification in your portfolio. And one of the things that I want to highlight about gold is that this rare statistical quality about gold, I view this as a bit of a miracle. Why do I view this as a miracle? Because this low, even negative correlation with the market is what I call a self-fulfilling correlation. That is a social phenomenon. The reason why there's a negative correlation between the market and gold is because when the market is doing badly, people get scared and they pull out their money from the market and they park it in gold because they believe gold to be the safe thing to park their money in. And the fact that they believe it makes it self-fulfilling. But the only way this happens, if it was just one person who believed that, it wouldn't have any impact. No one person moves market prices. You need enough of society to believe that you create this phenomenon. And look, different individuals in society are not perfectly coordinated. So the fact that like humankind, so to speak, has somehow evolved to coordinate, in their perspective of gold in this manner, that's what I mean when I say it's a miracle. because this is one of these things that, before it ever happened, it would have been, very difficult to imagine that something like this could happen. But, gold is a nice case study to illustrate that these social constructs of self-fulfilling, low correlation and supercharged diversification benefits, this is something that can happen because it has happened with gold. So it's important to know that, because now when we start to say, is Bitcoin digital gold, we have a bit more focus on what we actually mean when we're saying it. It's not just about this being a buzzword. It's about really thinking about, at a first principles level, what would it mean, right, for Bitcoin to be gold, and why, more generally, should investors care about that, both from a speculative standpoint and from a diversification standpoint. So now let me tell you a little bit how I approach, at a high level, this question of, is Bitcoin digital gold? So first of all, let me start with the punchline. Bitcoin is not digital gold yet, but it is trending. It has been trending over the past several years and resembling gold, more and more over time. And let me show you data that kind of supports that. As I said, right, the diversification benefit quality of gold was primarily about correlation with the market, right? Does gold protect you, or maybe even come to the rescue when the rest of your portfolio is doing badly, right? And so to try to get a sense of whether Bitcoin is starting to resemble gold in that sense, I asked the question, well, what is the correlation of Bitcoin with the market versus the correlation of gold with the market? So we can measure the correlation historically of both Bitcoin and gold with the market, and we can take the difference between those two correlations. So we can see in 2015, the difference in correlation, so the correlation of Bitcoin with the market minus the correlation of gold with the market, was positive and a bit over 0.25. It's a little bit higher in 2016, but there's something interesting that starts to happen in starting in 2016, is year by year, the difference in the correlation between Bitcoin in the market and gold in the market starts to fall. When this is positive, Bitcoin is not like gold at all, right? But as this number shrinks, it's smaller in 2017, it's smaller in 2018. What this is saying is the correlation of Bitcoin with the market is getting closer and closer to that low or negative correlation that gold has with the market. Maybe perhaps more interestingly, we look at 2019 and 2020, for those 2 years, right? For those 2 years, Bitcoin was more gold than gold, in the sense that it had actually a lower correlation with the market than gold has, right? So this is like, what I view as a trend towards digital gold. Okay. Now, one thing I want to tell you about trends is very few times in life will you find a trend that doesn't have periodic deviations from trend, right? Very few things in life are like a warm knife going through butter. Now, so why am I saying this? I've just added something to the slide. This is the difference in correlation between Bitcoin and gold in 2021. So 2021 so far, Bitcoin has been less gold than gold. That's why I don't want to say, Bitcoin is digital gold yet, because yes, in 2000, the trend here from 2016 to 2020 was promising. In some sense, we could say Bitcoin is more gold than gold, 2019, 2020, but that's not true in 2021.
Mm.
Now, the thing is, the difference is not too bad, actually, right? But, there's been a bit of an off trend here, right? I'm not ready to say that Bitcoin is digital gold until there is a long-standing amount of evidence that points to to Bitcoin really having that similar property as gold, and that this has stayed relatively stable for a period of time. So, this is me saying, as a financial economist who is data oriented, right? I have a high bar before I call a spade, right? I want to see a history of evidence. And that's just not possible with Bitcoin yet, because Bitcoin hasn't been around long enough. So I think someone that says, hey, it's obvious Bitcoin is digital gold already, someone who says that is making a faith-based statement as opposed to a rigorous, data analysis-based statement. But now, that begs the question, is there reason to have the faith? Is there reason to believe that, this trend towards digital gold will persist and will be resilient, so that when you have little periods of time when things seem to kind of go off trend, do people lose their conviction and then all of a sudden Bitcoin will no longer be like gold because you don't have that social phenomena anymore because people don't believe? Or are people's beliefs resilient so that if you see 1 year where it goes off trend a little bit, people still believe and it goes back to trend, right? So to me, that's the question that I ask myself is, do I have some evidence and some reason to believe that this trend towards digital gold will persist and be resilient, right? And in order to get some clues on this, I want to look at a case study around the start of the pandemic. So in particular, I'm looking at COVID case study where we look at the performance of the market, we look at the performance of gold, and we look at the performance of Bitcoin from February 2020 to April 2020. In my chart here, these numbers represent weeks. So 0 is loosely speaking when markets start to get impacted by COVID. That's roughly mid-February. Okay, people talk about March as being when the action was really happening, but I look at the data, I say I think it started slightly earlier. And what I've got here is the aggregate performance of the market over this 10-week period. Okay, so market went down, right? What happened to gold? Gold, no pun, maybe pun intended, right? Gold showed its true colors and it really shined during this period because, gold stayed steady. If anything, it went up in value while the market went down in value. That's what we mean by a negative correlation, right? So, gold was gold. It was its long established self. Okay. Now let's take a look at Bitcoin. And I don't want people to panic when they see this because I'll give some context here. This is what happened to Bitcoin. That does not look like gold. Okay. It kind of looked like, people panicked with Bitcoin in the same manner that they panicked with the market. If anything, they may have panicked a little bit more. So what does this tell me? This tells me, first of all, Bitcoin is not yet digital gold, because if it was truly digital gold, it would have shined and, been the insurance provider rather than the, zigging and zagging with the market at this point. Now, some people might see this and say, oh my God, how can anyone believe that this is going to become digital gold? Like, this is so counter to that statement, right? But here's one thing that I want to point out. I'm going to ask this question. Is the trend towards digital gold resilient? And what I want us to note is this was the beginning of 2020. Let's go back to my last chart. The rest of 2020, Bitcoin went back to being more gold than gold for the rest of the year, right? If there wasn't conviction and resilience on the part of the Bitcoin community and its growing market about the notion that, the reason to believe, or like that belief that the future, this trend will continue, right? If the COVID episode pierced that belief, we would not have expected the rest of the year to look like what we see with 2020 there. In other words, there was an important event that could have shattered belief, but it did not. And to me, that makes me believe in just how much conviction the market has. And it makes me believe that, this could become a social, norm, so to speak. And see, I'm not that worried about 2021 because, this is kind of like, loosely speaking, small. You guys hear me well? I just got an indicator saying my internet connection is unstable.
Back now. It's actually back now. It was only half a second.
Okay, so I apologize for that. I may have a PhD from MIT, but this is not a problem that I'm able to fix. Apologies. But yeah, it makes me a little bit less worried about 2021. And at the margin, it makes me, a bit more of a believer about this idea that Bitcoin could become digital gold. But let me be absolutely clear. We are not there yet. And, the point of view that I just illustrated to you, it's a belief that's based on a few data points, not the large sample of data that we usually rely on when we do the other stuff that we do in our portfolios, which is about optimal diversification. There, we really go with tried and true quantitative methods and look at long horizons of data to really get the most accurate assessment on how you should optimally diversify in your portfolio. So, we've talked right now why we think there's a reason to believe that Bitcoin might become digital gold. But I want everyone who is thinking or who has invested in our crypto version of our portfolio to be aware that at the end of the day, the belief that I just expressed, right? It's a bit of data, it's a bit of gut and economic intuition, but it is not like well-documented, long-standing fact. And so because of that, you really want to think of a holding in Bitcoin as a speculative bet. You are betting on the future continuing to trend towards digital gold. And our view is that if that trend continues, the performance of Bitcoin will be very good. It'll outpace other traditional asset classes. But you need to be aware that you are taking a bet here so that part of your portfolio is a bit different in nature than the rest of your portfolio, where the rest of your portfolio, the way that we design it, at least in our invest products, is done in a way that is not trying to speculate, but is trying to get you the lowest hanging fruit of investment benefits, which is minimize your risk while preserving your return, right? That diversification-based low-cost focus, that is our entire, I think modus operandi or something like that, for everything else in the portfolio. In the part of the portfolio for Starwood crypto that's Bitcoin, just note that part that's kind of like your little gamble on the side, right? And so you want to ask yourself, A, are you comfortable with that gamble? And B, like, you have a view, you may have a view of the future of Bitcoin. And so that allows you to reflect your view. You may even have like a value system around it where you're like, I want Bitcoin to make it because I'm a believer in the in at least some aspects of the financial system to be oriented in that manner, right? You can also, express your values in your portfolio in this way as well, right? But it is important. Like if you're someone who is a firm believer, I only want to do optimal diversification, right? Yeah, then maybe this isn't for you, right? So different people will have different reactions here, but it's very important for you to understand the nature of your implied perspective when you make a choice of Sarwa traditional versus Sarwa crypto. And so hopefully this discussion is helping clarify that.
I mean, just on that note, right? So, let's just say you accept that this is a speculative bet, that there will be a convergence to digital gold. But are there other benefits to holding it in a broader portfolio?
So yeah, but actually maybe before I answer that question, I kind of realized like I haven't really told you guys, some of the reasons why I think if the bet is true, the returns will be very attractive. I just kind of made the statement, but I didn't back it up with some economic justification. So let me actually kind of answer that first, and then I'll talk about some of these other benefits that have instructed how we choose the amount of Bitcoin to put into our portfolios. So the reason why I think that if Bitcoin actually eventually becomes digital gold, the value of Bitcoin will go up substantially. Now I say substantially, I can't really pin down an exact number, right? But the reason why I think it's a no-brainer if that bet is true, that this does well, has a lot to do with a few important trends that we see in financial markets, in government policy and fiscal stuff over the last several years. And I'll just point out two things to keep it relatively simple. The first one is one that gets talked about a lot in public discussions about Bitcoin, which is concerns surrounding the fact that many governments, for instance, the US, are kind of getting pretty aggressive at printing more fiat money, right? And so because of that, there's fears that there's going to be increases in inflation. And, basically at the end of the day, physical money, right, does not have a finite supply per se, because there's an organization in the background, a government in the background that has the power to print more and more, right? And sometimes that power can get abused to the detriment of holders of that type of currency. Well, by design, Bitcoin doesn't have that problem because there is a cap on the supply of Bitcoin. And so some people think that in that sense, there's less of a concern of a devaluation because of magnified supply. And so that might lead to a relative preference for Bitcoin, for instance, vis-a-vis the US dollar or another currency. And if that happens, well, that automatically means in US dollars, the value of Bitcoin will go up, right? So that's kind of one factor at play here. Some might wonder, like, look, there's a fixed supply of Bitcoin, but other cryptocurrencies can and do pop up all the time, right? And so is this really fixed supply? And here's where, like, I'll give you my perspective, and I think it's a well-informed one. I'm actually less worried about the supply of other new cryptocurrencies because Bitcoin has already experienced a bit of a miracle in having solidified community and resilient belief around Bitcoin as possibly becoming digital gold. What that movement that already exists does is it creates a barrier to competition that Bitcoin enjoys relative to other cryptocurrencies. You know, it's very difficult for a new cryptocurrency to say, oh, you know, we're the new digital gold, right? Because like that'll only happen once they've got a movement. But how do you start a movement when you're starting from nothing? And how do you say like my movement's going to be better than Bitcoin's when Bitcoin has like already an enormous movement? It gives Bitcoin this big major advantage. By the way, we see these types of, we call these network effects or marketplace effects, advantages that companies, or in this case, an asset can enjoy. I mean, let's take an example, right? Probably one of the biggest network effects in the world is Facebook. It's really difficult for another company to come and say, we're the new Facebook, despite the fact that Facebook does a lot of very controversial things. It persists, right? So barriers to competition. I think there's a barrier, very strong barrier to competition to, you know, introducing new supply versus, you know, via alternative crypto. I'm actually not worried that that's going to happen. So when I say fixed supply here, I actually kind of really mean it, even though they're you know, people can launch Dogecoin and Ethereum. Let's talk about something more serious like Ethereum. Those things have different use cases because they know if they try to do the same use case as what people are talking about with Bitcoin, they're not gonna win that battle. So that's one. And then the other reason why I think the performance would be really attractive is another fact that's been documented, especially kind of tipping point post-financial crisis, is that there's been a disappearance of safe assets in the global financial markets. So there's been research by academics at Harvard, MIT, and Berkeley on the disappearance of safe assets over time. And just to quote like a simple number, by their measurements, the percentage of safe assets as you know, so the amount of safe assets as a percentage of world GDP has fallen from 37% to 18% post-financial crisis. So halved, right? That's because some assets that used to be considered safe are no longer considered safe. When I say safe assets here, I mean really kind of think fixed income, like low risk fixed income. So if that stuff is disappearing and people still want to hold safe assets, they need to find other safe assets. Well, gold and digital gold are other safe assets. And so they'll want to put more into that stuff. That'll make the price go up as well. So the combination of those two trends is why I believe if gold becomes digital gold, it's a no-brainer. The value of Bitcoin will go up substantially. Now, your question about what else do we think about at Sarwa in terms of the merits of Bitcoin is something that we spend time thinking about. We try to be as comprehensive and rigorous about our thought process on things, especially something serious like introducing a new asset class, especially an emerging one within our portfolio. This is not a decision that we took lightly, right? So let me talk a little bit. So, you know, our bread and butter is thinking about diversification, right? So we did think about Bitcoin within this context. And so let me show you some statistical analysis that we've done to give you a sense of Bitcoin as a diversification tool. right? Basically what I mean here is Bitcoin now. And when I say now, I put it in quotation marks because what I really mean is, let's say Bitcoin over the last 4 years. It's 3 to 4 years. How has it been an effective diversification device? Now, I'm only describing the last 4 years. When I do diversification optimization for every other ETF in our portfolio, I'm looking at way longer horizon of data. I'm doing this period because this is really all the meaningful data on the new regime that I've got, right? And so let me show you what happens again. But let's be clear. I want to make sure everyone understands this, right? These pictures that I'm showing you now, these are pictures that describe Bitcoin's diversification benefit. In this first curve that we see here, it's from not 1918, I'm sorry, I guess I'm getting old, 2018 to 2020. And let me show you what this chart says. It's portfolio risk and Bitcoin exposure. And what this does on the y-axis is it tells us the level of our risk. So the lower the curve, the lower the risk, the higher the curve, the higher the risk. And we're looking at that level of risk as a function of your percentage exposure to Bitcoin. So think of a portfolio that's picked this way. I invest 3% in Bitcoin and the remaining 97% in the market. What is my risk? It's the X equals 3 point on that teal curve, right? So there's actually something pretty interesting to see here, which is as we add Bitcoin exposure, starting from a very small or no Bitcoin exposure, there's something that people might find a bit surprising, which is at least in the 2018 to 2020 period, for a small exposure to Bitcoin, your risk is actually falling, not rising, which is counterintuitive because we all know that the volatility of Bitcoin is mega high, right? 90%, 120%. In some years, it's been 150%. Really high volatility. We think of that as meaning like, of course, our risk is going to go up. But it turns out, again, in our recent history, right, for small exposures, we actually have been lowering the risk, which sounds like a victory, right? Let me show you some other data. Now I go not just 18 to 20, but 18 to 21, because remember we said in 21, Bitcoin has been a little bit less gold-like, right? And so we see there's not as much of a drop and there's a bit more of a rise. Overall, it's lower because volatility in general in 2021 has been lower than it was in 2018 to 2020. But I look at those two curves and I say to myself, I'm not extremely nervous to hold a little bit of Bitcoin in my portfolio if I'm willing to accept the recent history of the distribution of returns as a reasonable approximation of what we can expect in the future. And that's why we picked 5%. One of the reasons we picked 5%. You can see 5% in some sense, well, certainly the 18 to 20, it almost seems like the minimum point on this curve, right? So that's one of our, justifications for how we did things with choosing our Sarwa crypto portfolios. It was being mindful about the speculative bet and asking ourselves, like, how much conviction do we have on that? But telling our clients, we want you to think about that because, we don't want to be speculating for you in some sense, right? So we want to tell you the possibilities and we let you speculate on your values and on your beliefs. But conditional on that, we'll try to manage that risk as well as we can, right? So that we can kind of, there's your judgment, and on top of your judgment, we layer our best good faith attempt at using bread and butter optimal diversification techniques to keep your risk as low as possible. Now, let me say one thing to be clear here is these curves that I generated look at historical data over the last 3 to 4 years, right? Meaning these curves ignore the possibility that maybe someday people lose faith in Bitcoin and it goes way down, right? Because that hasn't happened in a truly dramatic sense over the last 4 years, right? That is not reflected in the math here. That's just a math. That's a mathematical fact. So I don't want you to like view these as the ultimate truth about the future, because there's no magic to be had. If something is very little data, we may not have seen the worst scenario possible, right? And we have to be cognizant of that, right? So what this statement really says is, it says, if the future of Bitcoin is somewhat in line with what the last 3-4 years have been, actually holding a little bit lowers your risk. But if there's like a black swan event or something like that, where you know, disaster happens, everyone loses faith in Bitcoin, then you know the value will go down. But by the way, that's another justification for 5%, because worst case scenario, it goes down to 0. Truly worst case scenario. And our belief as well is, for our customer base, given their age, their demographics, if you lose 5%, you can recover without too much pain in the long run. Right? And that's one of the things that we preach more generally across everything, right? Is to kind of stay calm and keep investing, so that, you know, if you do have a drop of 5%, right, you can recover, and you can take small measures, given that you're still young, like start saving a little bit more every month to make up that loss. It doesn't hurt as much, right? And so that's another reason why we're not like, let's go 10%, 20%, because we're like, look, if that 20% went to 0, that would hurt a lot more. And you'd have to make a more dramatic adjustment to stay on target on your financial path. Right? So again, just want to be very clear about what these numbers actually tell you versus what they don't tell you. Because I think there's a lot of people who talk about Bitcoin where they don't lay all the cards out like this. And so people end up acting on imprecise statements, or on statements that are better characterized as, you know, like beliefs not supported by data, but think that like this is supported by the data, right? We want our customers to really know what they're doing. And by laying these cards out like that, hopefully you guys trust that we are taking this, you know, product decision and how it fits with the customer very, very seriously. And that, you know, we're not doing things like this for buzz or to just quickly get new customers. We're doing it because we are trying to do the best job we can for our community, right? You know, like when I think about Sarwa in my brain, like to simplify it, right? I've always thought of it as follows, you know, my 2 words for Sarwa is Sarwa cares, right? We care about our customer, their, you know, portfolio performance, their broader ability to reach their financial goals, short-term, medium-term, long-term, giving them, I mean, I could easily over elaborate here, but you know, hopefully, you know, the way that we're doing this discussion, you know, provides people with a bit of evidence that is a little bit convincing. That you know, look, at the end of the day, all of our customers put their trust in us, right? And we are tremendously grateful for that. We are firm believers that trust in financial services must be improved in the Middle East. There's been a trust problem historically for a variety of reasons that are justified. And our mission in building Sarwa was to change that. And hopefully we are meeting our mission, which is to earn that trust, to not violate it, to make decisions like this in a way that that really are entirely focused on, what is right for the customer, and thinking about the different types of customers that we have. Some want to stay just on diversification, then we give them clarity, stick with the traditional, right? But some may want to speculate. And we want to give them the tools to do that, the right way. Sorry, maybe I went on tangent a little bit, but this is something
it's
we
actually,
always talk about this internally. So
exactly. So it's nice to kind of let the audience also hear that as well too, where our internal discussions are like. It's just I'm conscious of the fact that I know you've got a class that you've got to teach very shortly, and utilize as much of your time as possible to be able to address some of the questions for our clients. But I think we've kind of touched on this as far as why did Starwood decide to add crypto, right? But I'll let you continue. I apologize. Go ahead.
Yeah, so maybe kind of building on kind of what I was saying a second ago, part of our thought process in terms of like I've given you guys some statistical reasons and some, economic theory related reasons for why we, offer Starwood crypto, but I want to give you guys a last reason. And this is a reason that's going to resonate with some customers and not others, right? But our view is that for some of our customers, having that option to hold Starwood crypto instead of Starwood traditional will result in them being more engaged in monitoring their portfolio, maybe because having that exposure makes things a little bit funner, a little bit more interesting. And we want our customers to be engaged. We want our customers to pay attention to their portfolio. Now, we don't want to, jam 10 hours of homeworks down your throat every week. We want to make it easy for you to be engaged and easy for you to absorb. Why do I think engagement is really important? Because at the end of the day, right, through engagement combined with the educational content that we provide and, the personal advisor support that you guys get from Eamon and his team, right? That nexus of stuff, our hope is will accelerate our customers' knowledge and familiarity about financial markets and investments. And it's going to help them become more quickly sound and disciplined financial planners. And this is something that's important for achieving your long-term goals, right? And so our view is all of this stuff, in some sense, you can put it in the bin of empowering our customer to achieve their goals, right? Back to Starwood Cares. That's what it's about. That is what it's about.
Absolutely. I mean, even Starwood Trade, comes with the same energy and philosophy as well, which is to democratize investing. And the platform that is set to be released very soon is going to have zero commission trading, which already is always a barrier for many individuals when it comes to the cost of investing. And that's we're really excited about, because we're just on the verge of launching it ourselves. In fact, we all internally just got the message right now to start testing it out and whatnot. So it is ready, and we're playing around with it just to make sure we work out all the kinks before we release it publicly. And we're excited. I think it's going to go to great lengths to empower individuals to learn more. It's one of the things that I tell a lot of my clients is that the more interest you take in your finances, the more empowerment you will have and more control, which will set the tone for the rest of your financial career. And that's why we're really excited, here through Starwood, to be able to offer these solutions to our clients.
Yeah, I mean, I think, we have a lot of excitement around this new product, but, I think also we've had a lot of discussion internally about doing this product the right way and going back to like this notion of empowerment, but like smart empowerment, where we provide you with tools and information to learn to use your empowerment to your benefit, right? You know, there is some controversy around some other players in the space where you wonder whether they've designed their product to smart empower or to, for lack of a better word, dumb empower, by putting things in product that basically nudge people to become gambling addicts in their app, right? Look, there is historical data on people who view the stuff they do in financial markets as a way to gamble. It's called evidence on the performance of day traders. The history there is not a history of success when you look at the entire population of day traders. We don't want to do that. We want to create the product the right way, where you are empowered, things are democratized, but you are also given the tools to quickly learn, or to as quickly as possible learn, to be intelligently empowered. And we believe that aligns with our mission across all the products that we offer and all the things that we continue to think about when it comes to our community.
Absolutely. Thank you for that, Professor Kondo. At this juncture, I want to open it up to the, to answer the questions that have been posed throughout the seminar. And I want to start it off with this one that's come up a couple of times, which is the other cryptocurrencies that are available in the market and what its potential impact is on Bitcoin in light of what we just discussed today.
Yeah. So here's the thing: is like, I think within the cryptocurrency space, Bitcoin is unique because it has moved enough along the path towards becoming a social construct digital gold that it's tough for another player to go and position themselves as digital gold. So you've got a unique position for Bitcoin. And what that means is this is my view. Part of this is a theoretically informed view. I don't have data for this because it's never happened before, right? But other cryptocurrencies, I think the smartest plays in alternative cryptocurrencies think about what alternative value propositions they can offer. They don't try to tackle the Bitcoin value prop because of that movement type thing where there's a network effect. If it's tough to fight against the Facebook network effect. It's tough to fight against the Bitcoin network effect that's built so far. And so as a result, these other cryptocurrencies are about building community and movement, but around other value propositions. And there are certainly some interesting ones out there. I don't think we're ready to start taking much of a stand on those alternatives. Maybe Ethereum we could visit at some point, but the other ones, it's too early. Like, at least with Bitcoin, we have a few years. We have a few years of stuff where we can start trying to make sense of it all. But yeah, so hopefully that answers the question. I think Bitcoin is uniquely positioned within crypto. Other types of crypto could also add value as well. But from my perspective, it's premature for us to take this type of measured step for other crypto, just because of the limited history around stuff and the fact that there isn't quite as much clarity around the movement and the resilience of the movement for the other stuff.
There was a question here raised about the data that you highlighted for 2019 and 2020. And the question was that how do we ensure that data was not just an outlier rather than being a trend? Why have we opted to say that this is a trend versus an outlier, or vice versa?
I mean, look, at the end of the day, so let me tell you two things that I did. Okay. And so there is this thing called hypothesis testing, or, testing the statistical differences between things, to see whether, like, the earlier years and the later years, the difference in correlations is statistically significant, which then reduces our concern that this is kind of an outlier type thing. So I've looked at that, but what I did is I looked at 2015, 16, I'm trying to remember the years, 15, 16, and 17, compared that with 18, 19, and 20, and did a test on the difference of those two things. I can reject the hypothesis that they're the same. So I don't think over those 3-year windows, it's outlier driven. Now, when I go to like, 2020 versus 2019, there's no magic to be had in terms of using statistics because there's 52 weeks within a year. This is volatile data at the end of the day. So, there's the statistical statements that can be made in that more granular manner are weaker, right? So, so if you tell me one specific year versus another, could that difference be random chance as opposed to true trend? And the answer is that it could be. When you bucket into a larger number of years, that trend becomes more statistically identifiable. So and that is what it is. That's why we make sure that we give you guys the caveats when we talk about the trend and the idea that the trend may not continue. But I'm happy that question was asked because I probably should have also said, anything that whenever you look at historical data, there's always this thing called estimation error. So in any exercise like this, there's estimation error, and that's another caveat. So thank you so much for asking that, because it's important to be mindful about this, and it's important not to forget that we are expressing what we view to be a plausible view about the future, but we don't have pure conviction on it. So no one at Sarwa is like a go all in. What do they say? Hold on for dear life. Like that's not us, right? We're not. This is not a faith-based exercise, and so we understand that when we do this, it's not purely scientific, and so there is speculation where you could be wrong.
Thank you for that. There's a question here, and a lot of similarities between even traditional investing and even with Bitcoin. And this question does come up a lot in various different forums, which is, this question stated or asked, the price of Bitcoin is again high, and it's been very volatile in the last few months. Is it wise to subscribe now or wait for a better time?
I don't know what one means by like the price is high. I mean, it's okay, fine. It's near an all-time high. But here's the thing is like, given what I said earlier, right? If Bitcoin becomes digital gold, this so-called high number will look like a relatively small number, right? So like, whether you wait for the price to go down 10% or 20%, like at the end of the day, if the bet is correct, like the big kahuna on your performance is not going to be the fact that you were like wise or lucky and like delayed buying in and saved 20%, because like it's not going to be about that saved 20%. It's going to be about the 9x return, right? 9x, don't put a lot of weight on that because it's tough to pin a number like that down, right? But like to me, like it's kind of like, again, like I don't want our community to think that like I'm saying buy Bitcoin now. What I'm saying is, decide on your worldview. Maybe use some of the statements I make as part of your thought process around that. Do some additional due diligence outside of this webinar, and decide for yourself, like, do you feel like you have legit reason to believe? Are you comfortable with the possibility of losing up to 5%? If the answer is yes, then do it. You might as well kind of do it now, right? Instead of like trying to like over optimize. Like history of market timing is not a very good one, especially for folks who aren't like technical gurus that are able to kind of find these needle in a haystack insights to help them decide when to go in and out of market. Most people, when they go in and out of the market, it's out of fear or it's out of a false sense that they'll be able to time it right. And then what often happens is they lose like big run-ups, right? And you don't like, so that's my perspective there. You know, someone who's kind of waiting for it to fall 20%, you know, they might get lucky, and if it falls 20%, then they buy, they're better off. But they may also end up missing absolutely everything because it never falls 20%, right? If someone is like, I want to wait till it goes back down to 8 cents so that I can get like 1 million X return, okay, you know, good luck with that.
And it's funny, you hear similar conversations. I heard similar conversations back in 08 and 09 where people had missed that significant drawdown in the markets, and they had indicated that they're going to wait for the next one. And that basically
terrible
period of time where they've just missed out on significant, you know, portfolio gains.
And by the way, I mean, and we've posted content about this in blog posts and on our webpage, where we show, like, you know, if you're out of the market, you run a chance to like miss most of the upside of the market if you just happen to be out of the market on like the 10 best days over a multi-year period, right? So like you might think like you're taking a risk going into the market like this. You know, this is a statement about the market right now. Let me be clear, not Bitcoin specifically. But you may think like when you're like, you've got trepidation around, you know, investing in the market because you're like, I'm worried about the risk that this will fall, so I just won't put my money in yet. What you probably don't realize is you're taking another risk. You're taking the risk that you'll miss on the run up because you didn't put your money in, right? And again, like the in terms of like the history of financial markets, again, this is not about Bitcoin now. This is really about the rest of the 95% of the portfolio, or the 100% of the portfolio if you go with our traditional approach. I mean, the historical evidence, and this is not over 3-4 years. This is over, you know, more than 10 times that. It's very clear. You want to be in, you are much better off being in the market all the time than being out of it and missing a few key days. I mean, the difference in terms of your final outcome, financial outcome in the long term, is huge, right? I mean, there's been some other research by for instance, John Campbell in the economics department at Harvard, where he's looked at like trying to ballpark the cost of not participating in financial markets. And, you know, this is a study a little bit from the past, but the famous study that he did said basically like, you lose the equivalent of 4% per year. That's a huge difference. That's a huge difference when it comes to you being a young person and trying to achieve certain financial goals. That's a huge loss. And actually, that's another reason why we do this trade and crypto stuff, because, you know, if both of these products get additional customers who wouldn't have been compelled just by our invest product to invest in the market, but these two products get them in, even if we want to quibble on whether that's, you know, they're doing it the best way, right? Whether they're empowered perfectly or not. Like, if the comparison point is that they're not in the financial market at all, like imperfectly doing Sarwa crypto, imperfectly doing Sarwa trade is still going to be much better than not doing anything. I mean, unless you really, really go crazy on some trade stuff, let's say. And that's one of the things that we're going to pay close attention to when we launch this product, to, I think, right, to make sure that, you know, again, this kind of all goes back to Sarwa Cares, right? We're going to be always revisiting this question of, are we doing right by the community?
Absolutely. Look, on that note, I think we'll stop off the presentation now because I know you have to run to class, and you give me a hard stop at 7:15 because so you don't you're not late for your students.
Yeah, I'm sorry about that, everybody. It's you know, I've got my Starwood community, and I've got my McGill community, and I've got my family. Right, those are my communities.
For any of the questions, and there was a few ones that we weren't able to get to, for those ones that weren't answered, please do reach out to us. We're more than happy to have a discussion, with you guys, or reach out to anybody on the Starwood team. And we look forward to, having you for future webinars, and have a read up through our blogs, and keep an eye out for new, solutions coming out. And one being more imminent, the Starwood trade. So thank you, everyone. Have a wonderful evening, and thank you, Professor Kondo, for making the time available to have this presentation.
Thank you so much. And, Eamon, amazing job as always. And to everyone in the audience, thank you for coming. And we really appreciate, the fact that we can be partners in this stuff. So thank you very much. And to all of you, have a nice evening. To me, have a good rest of the day.
Everybody, take care.